Bandhan Mutual Fund presents MF Corner.
Hello and welcome to this special edition of Mutual Fund Corner YouTube edition. Thank you so much for tuning in as always. Now today what we're going to be discussing is going to be important, right? You all have sent us a lot of queries coming in on income plus arbitrage. We know what income plus arbitrage funds are. They're picking up pace as well. They're picking up and they're in trend as well. But who should invest in it? How should you go about investing in it? And what are the factors that you should be keeping an eye out on? We're going to be discussing all of that. And to discuss that, we have our expert joining in with us for today. We have Vatsal Shah, who is from Sushil Financial Services Private Limited, to talk to us about all of that. Vatsal, thank you so much for joining us on the show. Let's start by talking about income plus arbitrage funds. When you look at it, it's a combination, right? Arbitrage, debt strategies, that's combining there, and it's a mix of debt and equity. So how does this mix that is there for income plus arbitrage fund of debt and equity arbitrage strategies, how does this lead to better potential in terms of returns? What is the benefit in terms of after-tax returns as well? If you could start by that.
Yeah, so I'll just go about breaking it down for you. In income plus arbitrage, what we have is, so firstly, it is still a relatively new space. Out of the total debt AUM of 20 lakh crore, this is still about 20,000 crores. So I would say it is just kissing about 1%. But what we have seen is that the traction is pretty good. What has happened is that earlier debt funds had a benefit over FDs, right, by way of taxation. So there was an indexation benefit. So eventually, any investor who would invest in a debt fund after 3 years would almost get a tax-free returns because you are cutting it for inflation. You are removing inflation. Now the FM removed that benefit. So what happened was debt funds became at par with FDs. But last year, a new taxation came up for fund of funds. In fund of funds, what they said was that any fund which has less than 65% of debt will be long-term taxed after 2 years. So any fund, I'll just repeat it for the viewers, any fund which has less than 65% of debt after 2 years will be long-term tax, means it will be 12.5% tax. So this opportunity suddenly opened up. Funds also being creative in product, innovation. They started something called as a fund of fund, under which there is a group of debt funds. So what people would generally think is that there are, debt funds. So, they would actually think that, it's directly debt, but actually there are a group of debt funds and there is a group of arbitrage funds. So it's an umbrella of multiple funds. That's how it is.
Right, absolutely. Thanks for giving us that explanation over there because it's important now. But I just want to know, then does it indicate that we could see returns, and what is the returns in terms that one could watch out for from this fund?
So the benefit here is that you get about 7 to 8% on the debt fund. You will get about 7% on the arbitrage, and that will be taxed at just 12.5%. So effectively, after tax, you are getting about 6% on, sort of return in hand, which is better than the tax-free returns available today for investors. Now, the only thing is they have to hold it for 2 years. If they sell it before 2 years, then it will be taxed like an FD. That is the only difference here. That's the benefit.
Vatsal, what are these factors then that we should be keeping an eye out on as an investor? If I'm looking to start investing here, what is important before I invest in this fund? What is that checkbox that I should actually tick mark before investing here?
So the factor to be looked at here is actually whether you trust the debt fund manager. That's the most important, because here what happens is the fund manager will have a little bit of a free hand that they can, actually invest across multiple debt funds. Now you have to go by a fund manager who has a good pedigree of managing funds in debt fund. So that is how I think one needs to look at. The second part is on the arbitrage side, again, AMC, which has a good long-standing experience of managing arbitrage. Once you have these two aligned, then you are, I think, pretty much good with. So you don't need to then get into too much creativity because it's beyond your research, right? It's the fund manager's call that they'll take on the debt funds. Basically, they know that they have money for 2 years, so they'll try to time the interest rate cycle in a way that in 2 years, they can maximize the return for the client. So go with that approach only. I would say that go with funds which have, like for example, like a Kotak income arbitrage. It is not a recommendation, but they have a relatively good experience of managing debt. You have Bandhan, which has been, I think, the front running in safe debt. So, those kind of funds can be looked at when you are actually looking at income plus arbitrage.
Okay, that's interesting, right? It's important that wherever you invest, you should keep an eye out on the fund manager. What is his experience? That matters as well. And especially in these strategies, Vatsal is highlighting that this is important because the AMC experience matters when they are managing debt. How have they been managing debt in the past? So that AMC experience is also important. Vatsal, thanks for that key point that you've highlighted for us over there. But who should invest now in this fund, right? What sort of investors can go for it? Is it good for a conservative investor? Is it a safer bet? And can they also look at it?
So see, as I said that after 2 years, if you hold it for 2 years, then you will get net in hand 6.5% returns. Now returns is just one part, but when someone is say retiring, so if I have to just give it into more of the persona of the investor, a person who is coming close to retirement, they will get a large chunk. Now they want to take exposure in the equity markets. They want to have something in safety as well. So you can put say 60% of your corpus which you got from PF into these kind of funds, because after 2 years this will be more tax efficient than any FD out there. So instead of doing an FD saying that this is my retirement money and I'll put it in a debt fund or an FD, this is the best option for such kind of people. The balance 30% can be invested through an SIP route in equity or in a balance fund. Now after 2 years are done, because the returns are more tax efficient, they can start an SIP from this corpus itself. So that would be the approach for or anyone who gets money like a lump sum. Say it could be inheritance, it could be anything like a windfall. Suddenly, large amount of money has come, or a bonus. Then this can be a good option because this is better than FD. This is better than debt funds by itself because after 2 years it's tax efficient, and the returns will be slightly higher than a liquid fund because the fund manager will take little more active management calls in this. So that is how you should look at. That's how any investor should look at.
Vatsal, then does this mean that a young investor can actually look at it or not? Because they are ready to take higher risks, right? So does it make sense that they should have this sort of a mutual fund, income plus arbitrage fund in their portfolio?
So any young investor who wants to take higher risk, then definitely this is not suitable, because see, even a risky investor has some amount in safe assets. For them, someone who's young and probably in the highest tax bracket, they have to make sure that the money is in arbitrage fund, because after 1 year that is at 12.5% return. So you in shorter period of time it's getting more tax efficient versus an income plus arbitrage which is taking 2 years to become more tax efficient. So for a young investor, a mix of arbitrage and equity is better. But this is for mostly people who are nearing to their retirement or the likes of that, where they can actually invest in such sort of. The other thing I have seen is when people are buying a house, right? They have to make payments to the builders in slabs. Now they know that after 2 years I'll need so much chunk of money, and if they have obviously taken the loan and they have the money right now, that money also can be put in a such kind of a fund, because so anything which is timed with 2 years is good enough to go in this fund, because you will get slightly better return than a liquid fund.
Vatsal, you mentioned before that this was not a suggestion that came in terms of mutual funds, but now I want you to give us suggestions at which sort of mutual fund or which mutual fund would you suggest if someone is looking at an income plus arbitrage fund?
Yeah, so I would say that Kotak is great. Kotak income arbitrage, Bandhan income arbitrage is good. There are actually almost 7 to 8 funds out there. There is one which is Unify. It's a relatively new fund, but they have kept the expenses at the lowest. So, that can also be looked at. It's the lowest expense income plus arbitrage fund. So I gave you 3 varied suggestions. Yeah.
Sure, Vatsal, thank you so much, for joining us, giving us what it means in terms of income plus arbitrage funds, who can opt for it, who can look for it, and some suggestions coming in there as well. Thank you so much, Vatsal, for joining us on the show.
Thank you.
Bandhan Mutual Fund presents MF Corner.